headed for a recession. The bond market is indicating that, and the economic data is indicating that. What's also indicating that is people are buying a ton of gold and silver right now. Most of the gold is going to the industrial market, whereas retail is capitulating and giving up some of their shares. On the other side, people have been a little bit more bullish in the retail sector for silver, but overall, a lot of demand as silver and gold are both coming off of the major exchanges. I anticipate, especially in silver, we're going to reach a very critical shortage condition sooner than we will in gold, because silver is used heavily industrially.
Welcome to Gold Silver Pros.
Hi, everyone. This is Rob Keents with goldsilverpros.com, hosting your weekly market wrap-up for September 25th, 2023. It is a Monday morning. Good morning, everyone. Hope everybody is doing well. We've got a lot to talk about in the markets. What we're going to start off with is the leading economic data that we saw last week. And ladies and gentlemen, it's not good. It's starting to downturn uniformly now. Instead of having certain economic indicators do okay and others do not well. The home builder confidence index plummeted to 45 from a previous reading of 50. Economists thought it would hit 49.5. This is a continuing softening of the home sector. Anybody who has watched my channel at Gold Silver Pros on YouTube knows that about 2 weeks ago, I came out with a very pessimistic report on housing overall based on a lot of data factors. And we're continuing to see that here in the major data points about what is actually going on. Housing starts have also plummeted to 1.28 million from 1.45, again below economists' expectations at 1.43 million. Building permits are actually up 1.54 million, even though the starts are down and the sales are down on existing homes. The only thing that is selling right now are new homes, and new homes make up a much smaller percentage of the market than existing home sales. And the reason new homes are doing well is because consumers have decided if they're going to buy a home at today's prices and interest rates, they're going to do it on a new one, not an old one. So existing homeowners are not able to sell their houses. In addition, existing homeowners do not want to get out of their existing lower rate debt on their mortgages, which may be anywhere from 3 to 5%, to take on 7 to 8% mortgages, those with good credit. Initial jobless claims fell slightly from 221,000 to 201,000. Manufacturing is not doing so well. Philadelphia Fed manufacturing survey plummeted to a negative 13.5 last Thursday. Last month's was a positive 12. That's a 25.5-point move. And this is after New York Empire manufacturing survey 2 months ago plummeted to a negative 19. So manufacturing is being very, very highly stressed in the economy. And again, a lot of these readings were before the labor union strikes and the auto workers union, but they also reflective now of that additional pressure on the economy, as I stated would be last week. The U.S. leading economic indicators index, an index of major economic indicators that most economists follow, has fell to a negative 0.4%, duplicating last month's negative 0.4%. It continues to decline. The big economic factors that economists use to gauge and measure the economy has been negative for quite some time. Existing home sales, as I mentioned before, is down to 4.04 million from 4.07. The services PMI, the measure of purchasing managers index expectations of the services industry, fell from 50.5 to 50.2. Now it is still above 50, which signals a tad bit of growth, but it's only 0.2 above the 50 index, basically meaning we're stagnating. And when you consider inflation, it probably means we're actually declining. The U.S. manufacturing PMI, purchasing managers index on manufacturing, is up slightly to 48.9. Overall, the stock markets have gone red. The Dow Jones is down 120 points. The S&P down 6. NASDAQ is down 17. The Russell is up slightly, 0.72 points, basically even on the day. And the volatility index, the VIX, is up 0.67. Volatility is increasing on worries of labor union strikes and other things going on in the economy, which we'll get into. I wanted to start off talking about Treasuries first and the bond market, because everything is higher priced than the 10-year now. Typically, the shorter term issuances, the 1, the 2, the 3, the 4, the 6 month, the 1 year, the 2 year, the 3, the 5, and the 7 will be priced below that of a 10-year Treasury, because people expect the risk to increase as the time horizon lengthens out. Makes sense. You may not know what's going to happen in 10 to 20 years, but you feel like you have a good handle on what's going to happen from 1 to 2 years or even in 6 months. Well, the fact that those bond rates are trading at a higher rate, meaning investors demand more money on short-term bond issuance in the 10-year, means we're in something called a yield curve inversion, which is a predictor of recession. The 1 month is trading at 5.395, the 3 month at 5.481, the 2 year at 5.118, and the 10-year is all the way down at 4.529. That yield curve inversion likely means we have a recession coming very soon. Indeed, according to CNBC, a new headline today says the 10-year Treasury yield rises to start the week, trades near levels not seen since 2007. That's right. The 10-year is trading at levels seen since right before the mortgage crisis and the Great Recession that it started in 2018 in earnest. And that is a sign that given the mortgage market pressures and all the other pressures in the economy, we're headed toward a recession. The stories of the day that I want to talk about, I want to start off talking about the auto workers' strikes. Stellantis CEO warns of more auto plant closures in a story at Reuters. A quote, Chrysler parent Stellantis NV Chief Executive Officer Carlos Tavares said on Thursday that more auto plant closures will happen if high prices for electric vehicles cause vehicle markets to shrink from pre-pandemic levels. Automakers will risk losing pricing power as chip supplies recover, Tavares said at the CES technology trade show in Los Angeles. I think this might be a little bit of covering for the fact that the strikes are covering up what's going on, but I think also the entire auto market is falling down because people simply cannot afford the prices. It's interesting that they wanted to talk about the EVs there. I thought I'd bring that to you. There was positive talks between Ford and the UAW on Friday. However, Ford says significant gaps remain in labor contract talks as of Sunday evening. Quote from a Reuters story, Ford Motor said on Sunday that despite progress in some areas, it still has significant gaps to close on key economic issues before it can reach a new labor agreement with the United Auto Workers Union. The issues are interconnected and must work with an overall agreement that supports our mutual success. The UAW, which on Friday called real progress in talks, the number 2 U.S. automaker, did not immediately comment. The story at The Intercept is headlined, Confused Automakers Braced for Strike at the Wrong Plants. Striking auto workers pulled off a major coup before their strike, baiting America's largest auto manufacturers into self-sabotage. Quote, auto workers kept the big 3 automakers guessing about the union strike plans. The car manufacturers made a failed effort to help the effects of unprecedented labor action. Ford, General Motors, and Stellantis stalled production and moved parts out of plants across the country, according to rank-and-file workers. Self-inflicting financial damage that could have been avoided by meeting workers' demands. So it appears as though the closure of facilities and the movement of parts to other facilities is harming the automakers, and this ongoing struggle is only going to hurt the auto sector. What's considered the first time in history, a standing U.S. president is joining a picket line on a union strike. Story at Mish Talk is Biden to join UAW picket line as strike expands. Good luck getting repairs. The Detroit News quoted as saying, if we can keep them wounded for months, they don't know what to do and they're still helpless too. According to the POTUS Twitter account, quote, Tuesday, I'll go to Michigan to join the picket line and stand in solidarity with the men and women of UAW as they fight for a share of the value they hope create. It's time for a win-win agreement that keeps American auto manufacturing thriving with well-paid UAW jobs. CNN had some interesting comment on the president taking sides. Quote, Jeremy Suri, a presidential historian and professor of University of Texas at Austin, said he doesn't believe any president has ever visited a picket line during a strike. Presidents, including Biden, have previously declined to wade into union disputes to avoid the perception of taking sides on issues where the negotiating parties are often engaged in litigation. On September 15th, the day the strike started, Biden said the automakers should go further to ensure record corporate profits mean record contracts for the UAW. Some Democratic politicians have been urging Biden to do more. California Representative Ro Khanna on Monday told CNN's Vanessa Yurkovich that Biden and other Democrats should join him on the picket line. I'd love to see the president out there, he said, urging the Democratic Party needs to demonstrate it's the party of the working class. The UAW, in the meantime, has announced new strike locations, over 30 across the country, most of them in the East and the upper Midwest, some in Dallas, some in Colorado, and a few out west at auto plants. UAW President Shawn Fain called for union members to strike at noon Friday at 38 General Motors and Stellantis facilities across 20 states. He said the strike call covers all of GM and Stellantis parts distribution facilities. The strike call notably excludes Ford because they were largely in negotiation with Ford and hope to strike a deal. General Motors plants being told to strike in many, many cities, including Pontiac, Belleville, Ypsilanti, Burton, Swartz Creek, Lansing, Michigan, Westchester, Ohio, Charlotte, North Carolina, Memphis, Langham, Pennsylvania. Stellantis facilities included are Marysville, Centerline, Warren, Auburn Hills, Romulus, and Streetsboro, Michigan, Milwaukee, Wisconsin, Plymouth, Minnesota, Commerce City, Colorado, Naperville, Carrollton, Texas, New York, and Mansfield, Massachusetts. That is a lot going on with the United Auto Workers. And as I said before in the video last week, I believe that this is going to cause the auto market to continue to crash. One of the reasons the unions are striking is because their perception that the auto companies are making a lot of money and they want their fair share of profits. This is pretty typical before you go into a major recession, is when companies don't share profits or maybe not making the profits that they made before, that the auto workers will strike. It's also the fact that we have an inflation, a big inflationary recession coming on, in which we had stage 1 of inflation occur, a little bit of deflation, and now we're starting to see stage 2 inflation. Workers cannot stretch their dollars more. Wages, as I've shown on the channel many times, have not risen as high as the cost of goods, and that's why we're seeing strikes in many areas, including the United Auto Workers Union. We're going to see more and more strikes, I predict, across the country as we head further into recession, as people realize they cannot make their wages stretch across. However, this also hurts the economy. It raises the prices of things, because when less is made and you can't find parts, everything goes up. And it looks like the price of brake jobs is going up substantially, with one user on Twitter reporting a $1,300 cost of a brake job to his truck and the inability to have that done. So he's grounded. He can't drive. We also have further issues in the auto world. Toyota closed 14 assembly plants in Japan, as was reported last week. Toyota Motor has been ramping back production at its Japan-based facilities on Wednesday after computer system processing orders for vehicle parts broke down, forcing the closure of 14 assembly plants. This was not a cyber attack. It was software that led to issues with their Kanban system, which is their display board for where products need to go and what the demand is. That seems to have been recovering. But overall, the reason I mention this is because in September, we had so many issues across the auto sector across the world, and I expect that to raise the prices basically for automobiles across the world. A new story in from Zero Hedge, Chicago's $1 trillion financial engine at risk of leaving over $800 million tax proposal. This is originally, according to Bloomberg, the city's financial giants, traditionally known as a fulcrum of global derivatives market, says the story, has been greasing the gears of global trade for decades on what's now a $75 billion industry. Now they find themselves in the crosshairs of an $800 million tax proposal from Mayor Brandon Johnson. The plan, levy every financial transaction. The response, Chicago's financial elite are rattled, particularly as crime rates surge. Now a quiet mobilization is underway. These giants of trade who spend their days outfoxing each other in the markets are now colluding to push back against what they see as punitive policies, the story says. This new front sees them sharing data to amplify their value proposition, making it clear to policymakers the vast economic benefits to Chicago. We don't want to leave, but we cannot be disadvantaged in the world's most competitive market, said Ed Tilley, the CEO of CBOE Global Markets. Chicago remains a global trading hub, but that could change if the city, which is dealing with a major $538 million budget deficit expected for 2024, tries to find revenues as additional immigrants come to the sanctuary city, and as tax revenues continue to fall, as inflation has struck the economy and people spend less. The city of Chicago is dealing with a major problem that I think is coming to a city near you. And another issue of having issues, American Dream Mega Mall sees losses quadrupled to $245 million. In New York City, there is American Dream Mega Mall inside the Meadowlands. The massive shopping destination inside the Meadowlands saw its losses quadruple last year, according to the New York Post, sending the facility at a stunning $245 million in the red. The facility is having trouble attracting tenants and is watching customer foot traffic slow. And it opened just a few months before the pandemic, has never been able to recover, as it's never seen enough sales to recover from its multi-billion-dollar investment. Preliminary financial report indicates that the mall's operating costs soared to a staggering $428 million in 2022, nearly double the year's previous $232 million, the Post noted. Separate from its operating costs, the mall also incurred $350.3 million in non-operational expenditures, such as debt interest and restructuring fees, including debt payments, which reached $189 million in 2022. In the summer of 2021, the mall was drowning in debt, and they were hemorrhaging cash at the time. And I think at one point they only had a couple $100 in their bank account after making an interest payment. Those are the stories for the week. We're going to get into what's going on in the gold and silver market and share that with you. As we speak right now, gold and silver are trading just a little bit in the red. Gold on the day at 1960, 16.90 cents. I just popped to 19.17. Silver 23.22. Overall, I still think that they've been relatively holding serve over the summer, although they're substantially lower from their May highs earlier this year. And as we look at the commitment of trade reports, we're going to load this up front on the gold and silver analysis, and I'm going to show you why here in a moment. The silver exchange, or the silver side of the trade on the exchange, has not seen a lot of movement. Overall, you've seen some additional long positions taken by the producer merchants as they move the positions to forward months, and they drop 692 shorts, and they go a little bit more long on the trade, expecting prices potentially to rise. The swap dealers of the bullion banks have dropped a few shorts and added a few longs, but it's not big change in the net position. They're still net short right now. Again, expecting prices maybe to moderate a little bit until we get into the latter part of the year. The managed money added a little bit of longs, but silver has been relatively tame. The biggest mover were the other reportables, the wealthy individual and family offices, which removed a lot of their longs and added a few shorts. They're definitely expecting prices to fall. Moving on to gold, this is gold as of September 19, 2023. We're just looking at contracts and the big traders on the markets. You can see that the producer merchants over here dropped 2,000 longs and added shorts. They expect the price of gold to go short. The swap dealers also did the same thing, subtracted longs and added shorts, so pretty big tune. And the swap dealers are very heavy short on the gold price, continue to be and have been for many, many years. The managed money dropped their shorts and went long, taking the other side of the trade, and the other reportables dropped their longs. Overall, I expect the gold and silver price to moderate, maybe just fade down just a tad, although I don't see a big crash just yet on the chart based upon the trade I'm seeing. Let's go look at the futures trading on the markets. You can see that gold volume has been up as we have gotten near the end of September. But the main thing that I want you to notice is how many EFPs are going over to London. 3,784 is a Friday. Thursday had a 5,500. In fact, last week there were over 20,000 gold contracts that moved over to London seeking out the physical. That's because currently in September, there are only 803 contracts. And if you want a lot of gold from the COMEX, which people are taking gold off the COMEX, I'll show you here in a moment, you're going to have to go to London. So people are going to go to London. They're going to trade their COMEX contract over to London. 20,000 contracts last week basically were settled or moved over to London and potentially physically settled. As we look on the Friday's data in terms of trading to look at prices, you can see that December is still the dominant month at 139,000 contracts. Gold traded up $6 on Friday on that December contract. And on the December contract, it is down $27 on Thursday. On Wednesday, it was up 13.2. On Tuesday, it was up 0.3. So basically back and forth week on gold, a little bit of fade there last week, not a terrible amount, but you can see what's going on with the stockpiles. These are COMEX depository warehouse gold stocks. You can see, I'm going to go back to this chart here for a moment on volume and OI. Remember I said people are going over to London basically to get where I had over 20,000 contracts last week on December moved to London. Well, this is why, because the COMEX doesn't have a whole lot of gold left, and there may not be a lot of shorts willing to give up their gold for their short positions. So they may be offering to cash settle. So a lot of people that are looking for gold delivery, well, and you also don't have that many contracts in September. So they want gold delivery now. They're going to have to get it somewhere else. But I think there's also pressure to cash settle because you see the runoff in gold here on the chart. It's very clear that since, about midway through 2022, gold has just been rolling off of the COMEX, and we're down to just over 20 million ounces. A lot of that isn't registered, but only about half, about 10 million or so ounces, and registered 10, 11 million that actually could be delivered. The rest of this light green basically is savings, and it'll only come on the market if those private holders decide that they want it on the market. If you look at what's going on across the ETFs, most of them storing in the UK market, some here in the United States and New York and other places, you've seen a lot of red on the gold chart. Gold is flowing off of the worldwide exchanges and out of the ETFs. The last 4 weeks to the tune of about 1.7 million ounces net. So overall, people are taking gold off the market. They're buying a ton of gold, and that does not surprise me at all. As we look at GLD, a lot of gold is coming out of GLD as well. Shareholders are selling their gold. Authorized participants are allowed to remove that gold from the coffers when the shares fall. They only have to have enough gold to be able to support the shares are sold. So when the shares are selling off, the gold comes out. So gold is flowing out of everywhere, and you'll see the same in silver as well. Moving over to the silver charts, this is trading on the COMEX. This is where the spot prices are determined. In large part, the American part of the spot price of that spot price complex. You can see a decent amount of trading in silver over here. Again, I'm going to call your attention to December being the dominant month. 113,000 open contracts, only 31 open in September, 693 in October. So if you want some deliveries In October, you can get a few. Right now, you can get a few in September, but you can only deliver in the current month on the COMEX. Therefore, if you really want it, you're going to have to go over to EFP. And so there's some EFPs going on there as well. That's moving over to the UK market, 1606 on Friday, 700 there on Thursday. On Wednesday, there were 609. Tuesday, there were 903. And on Monday, there were 488. So several thousand silver contracts as well. Now, silver trades at 5,000 ounces per contract, where gold is 100. So you see, even though there are less amount of contracts, a similar amount of metal moving over to London, ostensibly seeking physical delivery, because you can't get it in COMEX right now because it's a light month, but also we're showing a moment where the stocks have been depleted. So I expect at the end of the day, December to be a big delivery month in both gold and silver, because people are actively going after it. All right, this is Friday's data as far as prices go. December is the dominant month. We saw 53,721 contracts close, up about 15.7 cents on the day. As we go to Thursday on December, we see 73,000 contracts traded. It was down 14.9% on silver. And on Wednesday, 57,000 contracts, up 38 cents. So silver actually did a little bit better last week overall in terms of price than gold did, although it was up and down just like gold was. Moving over to the ETF chart and the flow of the silver, we can see overall red the last 4 weeks to the tune of negative 4.6 million ounces. There was a flow into SLV, though, an astounding flow of about 4 million ounces. So a lot of the flow was out of the COMEX. So in the American market, a lot of silver has been taken out. Some of it's being added to London. I don't know if those are going straight from America to London, but it seems like some of that silver is flowing west to a little bit further east into the London market. And if we look overall at the silver stocks on COMEX, they have been falling as well for about 2 years. That started about the same time as gold in 2020 with the pandemic, people wanting physical delivery. So they started taking it off. But even after the end of the pandemic, people have been continuing to take silver off of the COMEX market. As we look at the SLV fund flows, we had a really big flow there on the 18th. And then other than that, it's been pretty negative around it. But the 18th saw a big flow in to silver. A lot of people buying the SLV. So you saw a lot of that silver go into that market. We'll see if it continues to fall back. If you look at a 3-month chart, most of the days have been negative with a few positive days lately. That's been helping out the silver price because retail is a signal to the traders on the COMEX that at least retail is demanding silver overall, although overall silver price has been fading just a bit. On the London market, we've seen a slight uptick in silver, as you can see here. Same as on the chart we showed before, and gold is relatively even. I wanted to point out on the Shanghai gold market, because we cover it, you know that a lot of the gold is delivered about 77%. A lot of the silver is delivered, I think it's about 18 to 19% on average of the contracts, much more so than in the American market. But the one thing I wanted to point out is that as of the latest report on the 25th, which is today's data, the reference price for gold on the Shanghai market is 2003 when compared with 1944 on the COMEX gold futures. There's a difference of about $60. So gold on those markets is trading $60 more on the Shanghai than it is here in the US. That is a lot going on in the last week. Let me summarize for you. The economic data is not good. Employment is sort of middle to decent, but those are usually revised down. So I expect that to come down. Overall manufacturing is absolutely crashing. And we have some other issues going on as well. So to summarize what is going on in the markets, we've had very weak economic data. We've had issues with manufacturing. It continues to plummet. Purchasing managers across both services and manufacturing are very pessimistic on the economy. Jobs overall flatline, but usually those are seasonally adjusted down. So I expect jobs to get worse. We've seen the return of inflation and the housing market continues to crash. A lot of people are telling me housing is going to be okay, that we need more housing units. To which I counter and say, no, we need more affordable housing units. People can't afford the increased prices with the increased interest rates. Therefore, housing prices have to come down before we resume positivity in the housing market. But I think we're headed for a recession. The bond market is indicating that, and the economic data is indicating that. What's also indicating that is people are buying a ton of gold and silver right now. Most of the gold is going to the industrial market, whereas retail is capitulating and giving up some of their shares. On the other side, people have been a little bit more bullish in the retail sector for silver, but overall, a lot of demand as silver and gold are both coming off of the major exchanges. I anticipate, especially in silver, we're going to reach a very critical shortage condition sooner than we will in gold, because silver is used heavily industrially. I don't know if that happens this year or next year, but I anticipate that will happen fairly soon because the worldwide markets of silver are getting thin. And it appears as though everybody's investing in gold because potentially of the oncoming recession. We know overall that the auto workers strike and the strikes in other areas of the economy are going to be potentially harmful to the economy, raising prices for things that were already too high for the average American to afford. Hopefully, with the resolution of working and settlement of the agreements, we can get back to making things and resuming the economy, although manufacturing definitely is taking a hit. Overall, I expect that we're going to head straight into that recession that economists have been predicting in the fourth quarter, either in the fourth quarter of this year or in the first quarter of next year. I don't think the government will call it until next year because we're already well into the third quarter this year, and they like to see 2 consecutive quarters of negative GDP. And this government's also been reluctant to call 2 consecutive quarters of negative GDP a recession, even though most of the financial economists and the financial analysts like myself will do so. But just expect a recession oncoming and know that gold and silver stocks, the availability of big amounts of gold and silver is falling on the market. So if you're interested in gold and silver as a retail investor, you may want to look at making purchases before the prices rise. Remember, third and fourth quarter, when prices tend to rise in the gold and silver market, traditionally, we could see some fade. In past years, we've seen some fade. Sometimes this late in the year, prices are falling and then it launches up at the end of the year. Sometimes in October and November, it just continues to march up steadily. I think that we may see some fade as the recession comes and a lot of the paper trades are sold, but then I think you'll see a nice launch ahead in gold and silver forward after that. The timing of that will be interesting as to when the recession is really hitting, not when they announce it, but when it's really hitting and affecting people in the market. I think you can see it in home sales. I think you can see it in auto sales. I think you can see it in credit card defaults and other things like that. So I think we're probably in a recession right now. And if you discount GDP gains for in rising inflation, we're actually negative GDP right now anyway, in a real sense, not in a nominal terms, but in a real sense. And so I think that there is, I think the average person knows we're in a recession right now. And as we get further into the stage 2 of this inflationary trend towards an eventual, what I think is going to be a dollar crash, I think it's going to continue to put strain on consumers. We'll continue to follow that as we do on the channel. Thank you, everybody, for joining. This has been Robert Keats with Gold Silver Pros with your weekly market wrap.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.